Hello and welcome to Startup Street. I'm Arundhati Ramanan, and with me from the Bangalore studio is Ritu Singh. These are the top headlines from the startup world. Payments gateway platform Cash-Free Payments acquires one-click checkout platform ZechPay for an undisclosed amount. ZechPay will operate as a wholly owned subsidiary of Cash-Free Payments. This acquisition will likely enable Cash-Free to offer additional value-added services like RTO reduction, fraud detection, and address pre-filling.
Electric motorcycle startup Ultraviolet Automotive is planning to raise $120 million in its next round of funding, which will be used to expand globally and grow its vehicle platform. This comes as the startup has commenced deliveries of its electric motorcycle, the F77.
Chennai-based women's fashion brand eShakti raises 12 crore rupees through revenue-based financing platform Club. The company will use the fresh funds for growth and geographic expansion.
Delhi authorities have warned Uber and Ola for allegedly violating local transport rules by providing two-wheeler bike taxis, as senior government officials told Reuters. The Transport Department on Feb 19th issued newspaper ads asking digital companies to immediately stop allowing personal bike taxis, which offer commercial ride-hailing services. Uber has sought a meeting with Delhi officials to discuss the matter.
US-based language learning platform Duolingo launches its kids literacy app called Duolingo ABC in India. It's a free app with no ads and in-app purchases designed to help children between the age groups of 3 to 8 years learn how to read and write in English independently.
BharatPe co-founder Ashneyi Grover's latest venture, Third Unicorn, enters the online fantasy sports market with a cricket-focused app called CrickPay. According to the company website, CrickPay will allow players to participate in public, private or mega contests to earn cash prizes.
The White House has set a 30-day deadline for U.S. government agencies to remove Chinese-owned social media app TikTok from all federal devices and systems. The ban, which was ordered by the U.S. Congress last year, follows similar steps by Canada, which cited an unacceptable level of risk to privacy and security as a reason.
EU antitrust regulators have narrowed their case against Apple, saying its App Store rules that prevent developers from informing users of other purchasing options violate the bloc's rules against unfair trading conditions. The European Commission dropped an earlier charge that targeted Apple's rules, which require developers to use its own in-app payment system.
Those were the headlines that we're tracking for you this evening. Now, on What's Brewing Today, Entangle's Lab has disrupted the market with its digital twin technology that powers services such as vehicle health monitoring, operations, automation, and driver behavior monitoring in the mobility segment. It also provides predictions on vehicle health. The startup has bagged $10 million in a Series A funding round led by Baring Private Equity. How does the firm plan to use the funds, and what is the growth plan? We are now joined by Anup Patil, the co-founder of Entangle's Lab. Anup, thank you so much for joining us on Startup Street today. Like I said, you essentially provide a whole host of services, including monitoring vehicle health, monitoring driver behavior via your digital twin and machine learning paradigms to OEMs and fleet operators. Talk to us about your technology and what exactly is it that you're solving for?
So first of all, thanks, Arundhati, for having us on the show. So Entangle's Lab has developed a proprietary technology where we have an entire end-to-end stack of solution. We have our in-house, completely in-house developed, design and developed black box that sits onto vehicles, canvas, and collects data at a massive rate. And then that data is sent onto a cloud platform, which is where we provide predictive insight in terms of the component level performance. And then we also provide deeper insight in terms of the overall driver behavioral aspects, and where we go beyond the conventional overspeeding, hard braking, and harsh acceleration, but give a deeper insight in terms of how the overall transmission utilization is and how it impacts the overall performance and the life of the vehicle. Then we also have a patented algorithm on fuel management, which is where we give insight in terms of the amount of fuel that has been filled. And if at all there is any kind of a pilferage, then the amount of fuel that has been pilfered along with date, time, and location. This has become a big a solution that has been adopted by OEs, fleet operators, and asset owners, and some of the large oil and gas companies who provide this as a value-added service. And that's where we are looking at using this round of fundraise that we have done with Barings in India.
All right, you've so far been catering to conventional fuels, and now you're looking to create solutions for the EV sector as well. So what's in the pipeline on that front? Have you already started something? What's the plan?
So on EV segment, we are already live with one of a large Indian OE as a standard offering on their platform. So on EV, we have moved away from digital twin and we are using ambient cognitive AI, where we use a host of other parameters from vehicle and in and around vehicle in terms of the driver behavior, ambient conditions under which it is being operated, and give a far more accurate level of prediction on the distance to empty or the SOC value of a battery and the age of the battery. But beyond that, Entangles is also now foraying into alternative fuels like LNG, CNG, and also working towards giving the solution in hydrogen-based fuel as well as a part of our larger expansion plan that we have in terms of our entire tech stack that we are developing.
Right. And you've raised $10 million. So how are you planning on spending the funds? Expansion and hiring is your top focus areas?
Yeah, so the primary focus is going to be now to expand across multiple countries. We are already seeded our solution in Australia, New Zealand, Turkey, Vietnam, then Belgium, Spain, some part of Middle East, and then North America. We also have a dedicated on-ground team where the solution will be rolled out and offered to OEs, fleet operators, and large enterprise companies as a part of our larger rollout strategy. So in terms of hiring plans, we will be aggressively hiring in sales, marketing, and to support this entire global expansion, we will also be hiring on the tech stack or the technology side as well to support this larger ambition of taking this solution outside of India to the global level.
All right. I'm going to talk to you about your global expansion a little bit more. But before that, talk to us about the traction you're seeing for your services out here in India. Where does your revenue stand and what's the growth target that you set for yourself for this year?
So we have been growing at a massive pace of around 3x year over year. And this year also, we are poised to grow at around 3x. Next year, we have an ambitious target of growing more than around 6x in terms of overall annual recurring revenue, and targeting at around 350 to 400 crores worth of revenue is what we will be planning to go after in the next financial year. So with that kind of a aggressive plan, we have seen a lot of traction, not only from the direct market where fleet operators are latching onto this solution, but most of the OEMs in the Indian market are now warming up to this or engagement that they are working upon and figuring out a way to roll out this as a part of their standard offering to their fleet operators. So all the large commercial vehicle operators are something that we are already in talks with and working in terms of establishing a partnership with them as a part of a rollout strategy just in India itself.
All right. And you were also mentioning that you've planted your seeds of your solutions in so many countries. When will we see it live? And what's the revenue mix you're looking at?
See, one of the biggest challenges that we have seen to roll out in these countries that I have just named is the level of compliance that is required, whether it is from the hardware standpoint. So we have already applied for FCC certification, and there are a lot of local regulatory requirements that are already that we have applied for. One, we anticipate that all these regulatory requirements will be completed by mid of April or end of April, and then a larger rollout will start happening across all these countries. So that's one part. But in terms of the overall revenue mix, in next financial year, we still see a significant chunk of our revenue will be coming from India, which will be roughly around 90-10, which means it will be still heavy on the India side. But year two onwards, we see a significant contribution from international markets. And pretty much we are looking at around 60-40 ratio, where 40% of our revenue contribution will start happening from year two from these international markets, where we already have seen a good amount of inquiry and traction that we have been generating in these markets.
All right, Anup, we're completely out of time, but thank you so much for joining us on the show, and we wish you all the best going forward.
Thanks, Arundhati, for having us.
Well, amid the large equity inflows into startups in these last few years, and then, of course, the funding winter, venture debt has been gaining popularity slowly, and it has now grown at a compounded rate of almost 22% in the last 3 years. According to a report by BCG and Trifecta, venture debt investments are projected to grow by 8 times to reach $6 to $7 billion by 2030. So let me invite the authors of the report to tell us more about this emerging trend. Joining me now are Anshuman Upadhyay, partner at BCG, and also Abhishek Gupta, who's a partner at Trifecta Capital. Anshuman and Abhishek, thanks very much for joining us here. And Anshuman, let me start with you. $800 million was invested last year across 100 deals. How is this expected to grow as far as venture debt is concerned in the next few years, and what is going to be the growth driver?
Venture debt today in India only accounts for 2% of the overall VC investments in the country. In more mature markets like the US, this number stands at 15 to 17%. So this indicates a huge headroom for growth at the very macro level. Now, if you look at where this growth is going to come from, on the demand side, founders have realized and as the startup ecosystem gains more maturity, they've realized that they need a range of financing solutions to cater to their inventory financing needs, to their working capital needs, to their growth aspirations, and venture debt fits nicely in there. On the supply side, more and more investors are getting aware of this as an asset class and the risk return profile that it provides. So this also gives it some sort of support to reach the 6 to 7 billion numbers that we project at the end of 2030.
Abhishek, coming to you, we've seen more of the startups which are unable to raise equity at the valuation that they want pivot towards venture debt. But, to what extent can debt actually substitute equity capital, or will it just extend the runway for the next equity fundraise?
There are two components, let me divide it that way. One is the secular growth of the venture debt, which is linked to the overall growth in equity. And second is related to basically the cyclical side of the things, which are like, as you said, there's a funding winter out there and there is a need for alternate form of financing to extend the runways. But having said that, overall, there are form of functions which need a part of equity and a part of functions which need debt part of it, right? So basically, for equity thing, you can have, imagine like your standard product developments, or when you're still like away from your product marketing fit, right? And then OpEx expansion, and then you have your customer acquisition. This should be ideally like financed by the equity side of things. But if I talk about the working capital, CapEx, right, acquisition financing, these are typical use cases for the debt side of the things. So it's not that, okay, it's a funding winter, that's why let's go for a venture debt. It's a process where you need to always optimize your capital structure, and depending on your nature of business use case, you should combine it effectively.
Well, it's not purely driven by the funding winter, of course, but when equity is not easily available, there is the option of debt, which has only emerged now in the recent years. But Abhishek, are there specific sectors where we're seeing more activity as far as venture debt is concerned?
3 segments, I would say, or 3 sectors, I would say, which are like where the use case of venture debt comes very natural. One is the venture consumer product and services. The second is the fintech, and third is what we have seen as a B2B platforms, right? So why these kind of business basically need more like an alternate form of financing? If you talk about the consumer product, consumer services, when like it's a working capital need, CapEx need, growth financing need, that's a very natural use case, right? For fintech, it makes a lot of sense to have venture debt for the onward lending piece. If you see, especially the fintech in India, they are more targeted toward the underserved segment, so they can justify that spread to have a venture debt for the onward lending part. And the third is the B2B, where it is a very working capital intensive kind of environment and platform. And there the venture debt use case is pretty strong out there. So basically, if you could see, if based on the research which we have done, 29% you can figure out for consumer product and services, 15 like around close to 19% for the fintech, and 13% for the B2B platform. That's the calendar year 2022 split for the deals.
Anshuman, coming back to you and leaving equity aside for a moment again, there are various kinds of debt even within that, which is available to startups as financing options. What's driving them towards venture debt specifically?
If you look at the entire life cycle of the startups at the early and growth stage, early to growth stage, there is not a lot of revenues that a startup generates. The product market fit is also something that the startups are trying to figure out. So at that stage, once the startup starts to generate some sort of revenue-based financing can be accessed. However, that's a costly form of financing. The interest rates vary from 20 to 25%. Now, if you look at on the other end of the spectrum are the bank loans, right, which is more for the late stage and the mature startups. So that's the cheapest form of financing. However, not every startup has access to that. In the middle is venture debt. So the interest rates are in the middle, 13 to 15%, and the ticket sizes are also larger. So typically it's around 20 to 25% of the entire fundraise. So that helps the startups cater to the different growth use cases that they have, whether it be M&A or your capex financing or your working capital needs. So all of those needs get catered to by venture debt, which are typically larger in ticket size, right? In addition to that, in our survey, what we found out was startups value the strategic partnership that venture debt funds bring in, right? So they're, in a sense, venture capital investors who come to the the startups and provide some sort of strategic input to the startup founders, and they value that a lot.
On that note, it is time for us to head into a short break. But coming up next in our special series, the Unicorn Health Check, we put the spotlight on India's online gaming unicorns. Stay tuned for that.
Back, we've kicked off our special series called the Unicorn Health Check with the aim to create a report card of India's most valued startups, delving deep into what is working and what is not. So today we're going to look at India's online gaming startup, and Arundhati is standing by at the big wall to take us through the data. Arundhati, over to you.
India's gaming market is expected to grow from $2.8 billion in 2022 to a whopping $5 billion by 2025, growing at a CAGR of 28 to 30%. Now, the number of gamers in the country is expected to expand from 420 million in 2022 to hit 500 million by 2025. In fact, between 2017 and 2020, the country's gaming industry expanded at a CAGR of 38% compared to 8% in China and 10% in the US. According to the World Economic Forum, mobile devices are the primary drivers of India's gaming industry. Now, affordable internet and the availability of faster smartphones with enhanced gaming capabilities have also fueled the market. However, in a bid to arrest increasing cases of addiction, various state governments imposing a ban on games of chance and online gambling. With this in mind, the government appointed MeitY as the nodal ministry to regulate gaming. Earlier this year, MeitY released draft amendments for online gaming rules to ensure that online games should be offered in conformity with Indian laws and that the users of such games be safeguarded against potential harm. Let's now talk about the financial health of the sector. FY22 turned out to be a tough phase for startups in fantasy, esports, and skill-based gaming space, as they couldn't hack growth as swiftly as they did in FY21. The pandemic had given wings to their scale in FY21 as people's outdoor movement was limited. In light of this, let's take a look at how India's gaming unicorns fared into FY22. India's biggest fantasy gaming platform, Dream11, continued its growth momentum in FY22 as its gross revenue grew over 50% and came in at close to 4,000 crore rupees. But at the same time, the firm's profit shrank over 56% in the fiscal year ending March 2022. Fantasy sports was the only source of revenue for the 14-year-old firm. Dream11 generates its revenues primarily by charging platform fees to its users who participate in fantasy sports contests. Dream11 has been sponsoring the Indian Premier League for the past 3 editions and onboarding a host of star cricketers as brand ambassadors. As a result, advertisement and promotional expenses claim the largest share of the firm's costs. On a unit level, Dream11 spent 0.98 paisa to earn a single unit of operating revenue in FY22. Meanwhile, MPL, or the Mobile Premier League, India's third most valued gaming startup, reported a 3-time surge in its loss to over 1,120 crore rupees in FY22 versus FY21. The firm saw its revenue from operations increase only 29% to 497 crore rupees in FY22. For context, the company's operating revenue grew over 8 times during FY21. Total expenses jumped 116% to 1,777 crore rupees as advertising and promotional expenses surged 81% year-on-year. India continued to remain the top market for MPL, contributing more than 88% to the startup's total revenue. MPL offers more than 60 online games such as fantasy cricket, rummy and speed chess with real cash prizes in paid tournaments and 1v1 games. The startup spent 3.57 rupees to earn a rupee of revenue. Now, multi-gaming platform Games 24/7 entered the coveted Unicorn Club in March 2022 after raising $75 million led by Malabar. The Mumbai-based company has become the third unicorn and second most valued startup in the space, followed by Dream11. Now, the vogue for fantasy and card gaming seems to have dropped post-COVID as the revenue for the Tiger Global-backed company shrank 24.4% to 1,160 crore rupees in FY22 from over 1,540 crore rupees in FY21. Games 24/7's operations mainly run on Rummy Circle and the fantasy sports website My 11 Circle. Total expenses stood at close to 1,500 crore rupees. As the scale shrinks, Games 24/7 losses were recorded at 282 crore rupees in FY22 after a profitable FY21, where it showed 110 crore rupees in profits. On a unit level, the company spent 1.28 rupees to earn a single unit of operating revenue.
All right, Arundhati, thank you very much for taking us through that. But on that note, we're going to wrap up this edition of Startup Street. Stay with CNBC TV 18. More news and updates will continue right here after this break.